In this industry, in the financial industry as a whole in general, the key to success is usually understanding patterns, being a student of history, and seeing things or realizing things rather before they happen, or rather before they become public knowledge. One of these events just took place today, and it's been taking place the last few weeks and months. And I'd like to share with the community and just go through them and to just, based on facts, history, patterns, see exactly what we can anticipate. And we've been talking about this, but let's just revisit this topic and bring it back again. The topic, as you see, the title is the way it's talking about how, if we realize how history usually has so much information for us and how we can benefit from it if we really take advantage of it and are students of it. And let's take a step and learn from the past and see how we can anticipate the future. So today's market, as you see, is really, really down. The top two cryptocurrencies, Bitcoin and Ethereum specifically, were actually climbing up to, or rather nearing, or even surpassing, or near to surpass all-time highs. Bitcoin went as high as 123,000, approaching 124,000. Ethereum was way above 4,700, actually about to close in on 4,800 before a bombshell came in, right? As we know, one thing we always need to take away from all of this is that this industry is a very sentiment-driven and emotional industry, meaning that a single tweet or a single interview or a single sentence said, a statement made, can change a whole sentiment and shift a momentum in the market. And to be specific, let's use the current event that just happened today. Why did the market collapse like this when it seemed so great right now? Everything seemed great, about to hit all-time high, both Bitcoin and Ethereum, and many others, even Binance hit all-time high. So both Bitcoin and altcoins were doing actually extremely well. What happened, right? So what happened was, let's start with this article right here. It's really straightforward. Bitcoin dropped below 119,000 after the U.S. Treasury Secretary Scott Bessent ruled out purchasing new BTC or Bitcoin, right? So it fell right after on Thursday, obviously today, depending on where you're from. It's Thursday that the U.S. Treasury Secretary Scott Bessent, like we said the government will not make new Bitcoin purchases to fund a Bitcoin reserve. This has been a campaign promise. This has been elephant in the room that has been just left unaddressed, right? And finally, the U.S. Treasury Secretary came out today and said, okay, look, this is what's going to happen. We're not going to, the government will not make new Bitcoin purchases, right, to fund the Bitcoin reserve. So this caused a lot of uncertainty as usual in the market, and it caused a huge sell-off. And huge sell-offs such as these usually also come with liquidations, and many traders have been liquidated. And actually, the entire market, crypto market, lost within the last 24 hours, lost over $100 billion from its market cap. So why are we discussing this, and what can we see moving forward? So first of all, this is just to highlight how volatile the market still is. It's a young market, so it's meant to be volatile. Actually, it's natural to be volatile because it's not as liquid yet. It's still a very young industry. Markets are measured based on their liquidity, and the more mature a market is, the more liquid it is. If you look at the bond market, It's very liquid, one of the most liquid markets. If you look at the stock market, if you look at the commodities market, but the most liquid ones are, for example, the forex market, hundreds of trillions. Bond market is hundreds of trillions, and real estate is, I say, only 51 trillion. So you see differences in different markets. Some are more liquid than others, and the more liquid they are, the more stable they are. For example, the bond market, global bond market, is it's like 140 trillion, and the US alone covers over 50 trillion. So that alone shows you that the more liquid a market is, the more mature it is, the more stable it is, and the more it is in demand. So this crypto industry as a whole is barely 4 trillion in market cap, right? And half of that, or more than half of that, actually close to 60% of that, is Bitcoin alone, one single asset. So what are we saying here? We're in the very early stages of a very volatile industry known as the crypto industry. It's still volatile because it's still not mature, meaning it's still illiquid. What does it take to be mature? We've discussed this topic before, and we are revisiting it now. So what it takes for a market to be mature eventually is it will have to go through a maturing phase, and that comes along with a bubble. We've always talked about this. So a market to mature, it will take a whole cycle. It will take it through a bubble. And once it goes through that bubble, there will be a few, maybe a handful or even less, that will emerge out of that bubble and become the market leaders. They'll become the Amazons, the Googles, the Nvidias, the Microsofts and Apples, right? And this is exactly what we're discussing. This is a bold statement. And as usual, I always like us to look at examples and verify what we say. Everybody can speak and say and make statements, right? But let's verify what we just discussed. So we have a very young industry. This is the industry of the future. It's the blockchain technology that is literally the next generation of the internet. And there is no more better comparison that we can look at or we can learn from than the internet itself, because the blockchain is just the next generation, next step, next upgrade from the internet. So when we see something, how the internet went through its dot-com bubble period, we can learn exactly and see what we can anticipate. It might not be exactly the same, but at least we'll be able to see how it's related, how we can build parallels and anticipate what's coming. And we have enough data, enough information as of today to make these assumptions and analysis based on facts, history, to be able to anticipate. Remember, when we started this session, we say that those who win in this industry are those that can see things before they happen and can anticipate things before it goes mainstream. And that's where real wealth is made, right? For those who see things before it happens and then they position themselves accordingly when the markets are still swayed and emotional and sentiment driven. So let's move forward by starting to or trying to verify what we just said. In a young market, young industry like the crypto industry that is still volatile, barely sitting at 4 trillion market cap, with more than half of that market cap simply from Bitcoin alone. And due to its volatility is due to its lack of liquidity. Lack of liquidity means it's a very young, immature market. To be a mature, become a mature and fully developed market, you have to go through a bubble, right? And this is now what we're going to build. How are we going to, what can we anticipate in the next coming years, so that we can position ourselves accordingly and make the most out of all of this. When you hear bubble, usually it's connotated like with negative conditions or something negative. However, if you understand how to position yourself and make the most out of this, it's actually something excellent. It's something great that you want to be part of. And the best way to make the most out of it is to understand how the dot-com bubble took place. And now then, based on those facts, we can then anticipate how we as an industry, still very young industry as of now, will know how to navigate through all of this. So let's kickstart. So the first thing, if you want to really understand all of this, is obviously to be a student of the dot-com bubble. What took place and what is it? What caused it? What was the impact? And what are the lessons that we can take away? I'm not going to go through every detail of this article, but it's a very, very juicy article that really has a lot of things, a few things that I would like to share with the community. So first of all, the dot-com bubble obviously was a rapid rise in the US technology stock market, right? It was fueled by investments in the internet-based companies during the late 1990s, to be specifically from 1995 all the way to year 2000. So it was basically a build-up between 5 to 6 years. So that's what the dot-com bubble period is, and that's what it was about. So it was fueled by this new technology known as the internet, and it was fueled by VCs, venture capitalists, that were freely putting in money in these dot-com companies, or rather internet companies, during this period, like we discussed, between 1995 and the year 2000. So let's dive deeper and really understand just briefly what all of this was. So it was known as the dot-com bubble is known as the internet bubble. What I want us to highlight here is that you see how it's specifically known as the internet bubble, because the technology at that time was the internet. That's the technology at that time that led to it. So if we relate it to today, it will be called the blockchain bubble, or it will be called the blockchain companies bubble, right? So what we need to understand is that it was a period of speculation, and it was a speculative mania that drove US tech companies, stock companies, sky high during the late, like we said, 90s, right? And without just putting numbers, let me just put some numbers and highlight some numbers. So right now we know that the largest tech exchange right now globally is the NASDAQ, right? And it went basically from 1,000 points all the way to 5,000. So it did a 5x within 5 years, from 1995 to 2000. So during this period of mania, like speculative mania, it lasted within a period of 5 years. It went up by 5x. And this is the entire stock market. So imagine if the entire stock market went up by 5x. So you can imagine individual companies by how much they went up, right? For example, it will be like right now we are at a 4 trillion market cap, the entire market. So imagine doing a 5x from here. So going from 4 trillion market cap to 20 trillion. So that's how massive it was. And it does that in a short period, like within 5 years. That's a huge jump, because keep in mind, it took this industry 16 years to get to this place. It took 16 years to be at 4 trillion market cap right now. And this 5x would happen not within 16 years, it will happen within 5 years. So it just shows you what how impactful this dot-com bubble was. So let's dissect it. Now that we know that, let's just look at a few numbers here and a few things that I would like us to take away from all of this. So obviously, what I also want us to understand is that by the end of 2002, specifically October 4th, 2002, the market, right, declined by over 76%. And many so-called dot-com stocks went bankrupt, and even established companies like Cisco, Intel, Oracle saw their stock prices erode by 80%. So even market leaders like of today had their stock prices go down. So nobody was spared. The entire market went down by almost 77%. And individual companies, as we know them today, market leaders, went down by 80% during that period. Also, what I want us to understand is all this crash was so massive that it led to a prolonged financial recovery. It took NASDAQ 15 years to reclaim its previous high, right? And it didn't reclaim it until 20 April 2015. And keep in mind the bubble burst in the early 2000s. So another thing that I want us to look at, just a few facts here. Like again, just to highlight, companies like Amazon, obviously eBay, Priceline managed to survive the crash, while others went bankrupt as the market corrected itself. So the market always eventually corrects itself as it goes through the maturation period. The markets become mature whenever there is a huge influx in liquidity, and then it flushes out the real players from those that really have no strong business plans and so on and so forth. So what I want us to also understand here is that the dot-com bubble, also known as the internet bubble, grew out of a combination of speculative, like we said, it was based on speculation or Fed-based investing, meaning that the abundance of VCs, venture capitalist funding for startups, and the failure of dot-coms to turn into a profit, right? To turn into a profit. So basically what this just means that there were those that sitting on the sidelines with deep pockets, and they wanted to be part of this new technology. And there also are so-called entrepreneurs that came up with startups that wanted to be revolutionary and use this new technology. Back then, the internet, now it's known as the blockchain technology, and they're launching blockchain-based companies and going through IPOs. And this is exactly what happens. So many investors and venture capitalists abandon a cautious approach for fear of not being able to cash in on the growing use of the internet. This is exactly what leads to the early stages that lead eventually to a bubble. Investors and venture capitalists alike, investors like you and I, or venture capitalists are large capital companies, capital intensive companies, meaning companies with deep pockets that are solely built to invest in early stages of startups. So they are having a FOMO, right? Fear of missing out, or fear of not being able to cash in on the demand of this new technology, or on the cashing in on this new technology known as the internet back then and known as blockchain today. So we'll see parallels very soon. But let's just look at one more thing here. Many companies, many startups were in a race to quickly get big, right? And like we said, capital investors were throwing money at this sector because eventually there was so much money, easy money, as we're about to see. So companies with no unique technology ignored fiscal responsibility, spending heavily on marketing to stand out. So this is exactly what we talk about. Instead of focusing on fundamentals, you focus on just marketing things to stand out, but you are not focusing on the real fundamentals. What's the added value? What's the solution to the challenges that you're addressing? So they spent a fortune on marketing to establish brands that would then set them apart from the competition. And some startups even spent over as much as 90% of their budget on advertising. So this is how it works. Now, this is where I really want us to take time and really understand. So again, record amounts of capital started flowing into NASDAQ back in 1997, at the heart and heading to the peak of this bubble. A bunch of capital was flowing in there because there was this new technology that just came out publicly 4 years ago, 1993, known as the internet, and many entrepreneurs that had anything to do with developing websites and using this technology were being financed by these venture capitalists, whether they had a solid business plan or not, and they went public. So that year, most of the 457 companies, IPOs, were related to internet companies. So imagine, this is what we're experiencing today, as we're about to see as well. So IPOs didn't just start today or yesterday with Circle and Coinbase, but it's been happening in the early 90s during the dot-com bubble as well. So we see parallels here already. So initial public offerings back then were heavily focused on the related to the internet companies. Like right now, a lot of blockchain companies, treasury companies, utility companies are just spinned off out of nowhere, out of thin air, just put together within a few weeks and get listed through IPOs. That's the same thing we're experiencing today. But before we start doing that, let's look at one final thing here. One thing I want us to understand here is that the internet commercialization drove the biggest capital growth. We are experiencing the same thing right now. So right now, the commercialization of the blockchain technology right now that is becoming so popular and mainstream is the biggest capital driver right now. So capital is getting ready to flow into this blockchain technology and this blockchain industry simply because they hear that the JP Morgans, the BlackRocks, Visa, MasterCard, UBS, and all these various companies are heavily invested in this industry. And so investors and VCs are heavily focusing on not missing out and jumping in on all of this and trying to also make profits, of course, without focusing on real companies with real fundamentals, right? Like it says here, the bubble that formed over the next 5 years was fed by cheap money, easy capital, market overconfidence, and pure speculation. That's it. So venture capitalists anxious to find the next big score freely invested in a company with a .com after its name. So valuations were based on earnings and profits that would not occur for several years in the business model actually, if the business model actually worked. And investors were all too willing to overlook traditional fundamentals. So we see how if your approach is just to see the price going up and you have no business model, you have no fundamentals, it's pure speculation, like it says here. It was just based on pure speculation, and anything, VCs invested in anything, any company with a .com in it. So any company with AI, blockchain, smart contracts, DeFi in it, money's being thrown at them, and they're going through IPOs, initial public offerings, right? So this is exactly what we see here. So another thing that I want us to look at here is that is this right here. So companies that had yet to generate revenue, profits, and in some cases even a finished product. So most projects didn't even have a finished product. They never even generated any profits, but they went public through an IPO, initial public offering, and they saw their stock price triple, even quadruple in one day, creating a feeding frenzy for investors. So whenever you see IPOs going out with that are focusing on the blockchain companies, so-called blockchain or cryptocurrency companies that are going through IPOs, and you see that their stock prices just triple or quadruple that same day they launched. These are the signs of what's coming, and we can anticipate them. So based on this alone, community, I'll come back to that, but I just want us to look at one more thing. So why did the dot-com bubble bust? So this is a summary. So the dot-com bubble bust when capital began to dry up. Whenever you take out liquidity, that's when you realize what was fundamentally sound and what was not, right? Because by the time liquidity is being taken out, if you have a solid, fundamentally solid cryptocurrency ecosystem, it shouldn't bother you, because by that time you should have accumulated liquidity of your own. You should have been burning your supply, become deflationary, if not scarce. You should have been having sustainable staking distributions to maintain your holders to remain staked and hold your token and secure your network and stabilize your network. And if you've done all that right, you would be using your volume efficiently, and you won't be relying on anything else but your volume, your trading volume based on your fundamentals that are using that volume efficiently to burn the supply, accumulate liquidity, and to retain liquidity and accumulate the USDC distributions in a very efficient and sustainable manner. So that's why the bubble burst in the first place, is when capital started drying up, liquidity goes up, the bear market starts kicking in. Because during a bull market where easy money is around, easy capital, there's no fundamentals required. But once liquidity starts drying up and the market starts drying up, that's when fundamentals are really important. And that's when you see the real companies such as the Amazons, the Googles, the Microsofts, Apple, Nvidia start to come out. And the rest that are fundamentally weak or have no fundamentals or no products whatsoever, no solutions to challenges within the industry, they're not going to make it out of this bubble. So bubble is actually a baptism of strong, fundamentally sound and efficient and sustainable companies that come out of this maturation stage within an industry. Every new industry has to go through this bubble, and only the fundamentally sound ones come out of them and become market leaders. So this is what I really want us to understand. So this led to companies, many of which didn't even have a business plan or product, to collapse, causing a market to crash, right? So this is it. Because what we need to understand is, in the years preceding the bubble, record low interest rate. So another thing is record low interest rates, right? Everybody's calling for interest rate cuts. So there was a record low interest rate, meaning easy money, cheap money. So the adoption of the internet, so adoption of a new technology, back then the internet, now it's the blockchain technology. And then interest in these new technology companies allowed capital to flow in freely. So a lot of interest in these technology companies allowed capital to flow in freely. So if you hear all these spin-offs being listed on New York Stock Exchange, NASDAQ, and they're just weeks old, never had any revenues, and their stock prices triple on on launch day, quadruple. These are signs of what's coming that we can anticipate. So if we go back here, I'd like us to go back here. So companies that had yet to generate revenue, profits, and in some cases even a finished product went to market with IPOs, right? So, and their stock prices tripled and quadrupled in one day. Let's verify that. Let's really verify that, because we see that just happened actually today. So if we take the latest example, we see here, okay, right here. Okay, so there's this new company, crypto company that just came out. It's a crypto exchange called Bullish. It literally just launched today. It hit the market, the New York Stock Exchange, with over $13 billion in market cap, right? So this is one that just came out just today. It went through IPO, and it started at a price of $37, right? That's what the price it started with. And the market reacted very positively, obviously, right? And it was doing big numbers. And this is exactly what I want us to look at right here. Remember what we just read, that during the bubble or preceding the bubble, IPOs with no revenue, no track record, no history, no business plans were doing numbers on launch day. So let's look at this. So like we said, the stock opened at $90. It traded over 150% of its IPO price of 37. So it did it tripled, right? It tripled. And it went as high as $118 before pairing gained slightly, right at 92. So this is exactly what we were reading earlier. You see brand new companies with no track record, with the only thing they have is, okay, we are a crypto company, we're a crypto exchange company, and they hit billions of dollars in market cap, and they triple and quadruple their stock price in the same day they launch. Isn't this exactly what we were reading about? And the IPOs are going left and right. Circle just IPO'd. Coinbase IPO'd, and there's many more. Gemini is about to come in and we have an initial public offering. Grayscale, these are all crypto-based companies that are getting ready to go through an IPO. And we see that bubbles are always preceded by IPOs, initial public offerings. And every venture capitalists and investors are heavily investing in these startups in the hopes that they'll make big profits, because these companies might be the next Amazons and the Googles, right? And the Microsofts and Apples that eventually will be in the trillions of dollars in market cap. And this is exactly what we were talking about, that if we study history, we can anticipate what's coming. So how are we relating all of this? Why is this so relevant? What are we saying here? Besides what we've said so far, another interesting thing is about the interest rate cut, right? So far, we've been always talking about interest rates cut. So far, Jerome Powell has been refusing to even discuss interest rate cuts, for the simple reason because the tariffs are potentially might cause inflation. And also, since the stablecoin bills have passed, Jerome Powell doesn't see the reason why cutting interest rates should be the case if stablecoins issuers will be required to purchase treasuries, US treasuries, to back their stablecoins with. And once that happens in the trillions of dollars or even hundreds of billions of dollars, it will naturally bring down the rates, because the more demand there is for treasuries, that's how the rates are naturally, organically being brought down. That's how it works. So one way or the other, with the stablecoin bill being passed, and now these large institutions, we hear rumors that Amazon and Walmart and Facebook want to, or Meta, getting ready to launch their own stablecoins. We hear financial institutions and non-financial institutions getting ready to launch their tokenized versions of their deposit tokens or stablecoins, and they'll be required to back these stable coins that they issue with US treasuries, which are US debts. And once that happens, it will bring down interest rates naturally. It will make access to money cheaper, and so on and so forth. So anyway, one thing that has been is now being talked about is the prospect that the Feds may cut the rates next month in September, based on some facts. So, and this is what I would like us to look at. So what are some of those facts? So the job market numbers have been not accurate so far. They've been more bullish than they actually were. And so and this has been this led to sitting President Trump to even let go, or rather fire, the individual that was responsible in reporting these job numbers, and they were reporting them so falsely that they had to be let go. So those are some of the reasons also why there's a high chance right now. So after the report, there was a 94% chance the Fed would cut interest rates by a quarter point in September. So it came up from 85% to 94%. So there's a high probability that based on these things, this information, next month could be the first time that the Feds are going to cut interest rates. This has been something that has been called for so long, and we all know what that means. Once you start cutting interest rates, that opens floodgates to liquidity, and also at the same time, it also will cause inflation down the road. But in meanwhile, once the money printing takes place and the liquidity is being issued into the markets, it causes it also part of sparking the not just the bull cycle, but also push the bubble even further. Like we saw here, I really want us to understand this. What caused the dot-com crash? The growth of the internet created buzz among investors, right? And they were quick to pour money into the startups company. And also what I want us to understand is that this right here, record low interest rates. So interest rates are getting ready to be cut starting next month. 94% of the market is speculating and anticipating that to happen. So interest rates were cut. Adoption of the new technology, the blockchain technology, interest in these new technology companies will allow capital to flow freely. All these IPOs and all these startups are being financed and financially backed by these VCs, right? So we see that these are exactly the things we're experiencing right now as we speak. Low interest rates is coming. One way or the other, either through stablecoin issuers that will be forced to back their stablecoins with US treasuries. Once this takes place, it will bring demand for the US treasuries, and then that demand will bring down the interest rate. Or next month, like we said, there's a 94% chance that next month the Feds will start cutting interest rates by a quarter of a point. And this, of course, will also stimulate the economy due to influx or injection of liquidity into the markets. And this will all feed into the bubble, because once the liquidity or money gets, easy money is available, that means that risk assets such as the stock market, or even more riskier, the crypto markets are going to benefit the most from it. Predominantly Bitcoin and Ethereum. And Ethereum even more, because Ethereum, first of all, is the largest and number one smart contract blockchain. And all these staking and restaking or liquid staking has just been green-lighted and is not considered a security. Ethereum ETF staking also getting ready to take place. All these applications and all these crypto blockchain companies are mostly launching on Ethereum as well, building infrastructure on Ethereum as well. So these are things we really need to understand. And this is why I wanted us to highlight and understand this. So to summarize, you need to look for projects with real, that capture fees, that the best example, for example, is if you have blockchains that capture fees, such as Ethereum, for example. With every transaction, you have to pay gas fees. And these gas fees are used to burn the supply, for example. So this makes Ethereum even more deflationary than Bitcoin itself. Another aspect I would like us to look at, and I'm about to break it down with our ecosystem, but let's go through another option as well. So also look for blockchains with users, a huge user and developer base as well. So which blockchain has the most users? the most developers? That's something that you need to look at. Where's the most activity? Look at where the infrastructures are being built, not hype, infrastructures, such as payment rails that Visa and MasterCard are putting together, infrastructures that BlackRock is doing. They're building products like BIDL, for example, or tokenized assets, like tokenized money market funds. Like JP Morgan, they have infrastructures built for their tokenized collateral network, where they're using BlackRock's tokenized money market funds or tokenized treasuries as collateral for the derivatives market, for the over-the-counter derivatives market. So we see how infrastructures are being built, payment rails are being built, staking platforms, services are being offered, DeFi products are being deployed and developed. All that takes place on the largest platform right now, majority of it on Ethereum. All stable coins, majority are there. Commodities, tokenized treasuries, real-world assets, predominantly on Ethereum as well. So these are things that lead or tell us who will eventually have the best chance to come out of the bubble victoriously and as a leader. And that's where Ethereum wins or takes the lead, because they have the most developer base, most user base as well, in terms of smart contract DeFi applications, and also infrastructure based on institutions. So another thing I would like us to also look at and understand is that if you're are you part of a solution, or you are part of the problem? And the best way to really highlight, understand, and the best way to navigate through that question and to verify whether you're part of a solution or part of the problem is you need to understand one thing. Do you have fundamentals? What are your fundamentals in terms of as an ecosystem, as a token? Do you have fundamentals? Do you strive to be part of a solution? What's the added value that you bring to this industry? What are the challenges that you are addressing that we faced with in this industry? And this is exactly where BullRun is shining the most, because like we say, we have four major challenges in this industry. First and foremost is inflation. And this is something that plagues the entire financial industry on a global scale, including central banks. And this is what the largest, our current monetary system is based upon, debt-driven monetary system, causing inflation by stimulating the economy. And when you have inflation, that means you're losing your purchasing power. And also this means that you're raising your debt ceiling. So you see all these challenges, you can't just bring them on chain and think that because these products are now on the blockchain, now they're good. And this is exactly how bubbles are built. People are just taking the existing challenges without addressing these challenges, wrapping them on a blockchain and calling it the next new thing. And this is how bubbles are formed. So you're just taking a problem in the traditional world and then putting that same problem without fixing it on chain, and then claiming that now it's going to be better. But if you don't address inflation, lack of liquidity, unsustainable staking distributions, and inefficient use of your volume, even if you put that product, that ecosystem on the blockchain, it's not going to solve the problem either. So you're part of a problem, not a solution. So because, just to briefly go through this, the way we address inflation is by having this true burn mechanism, where our supply started at 1 million in total supply. Now we're down to 961,000. And with every trade, with every buy and sell, our supply is literally becomes scarcer and scarcer. Let me share this with you, because we can talk, but the best way is to see it. So we can see here that we started with 1 million in total supply. Now we're down to 960,000. And this supply keeps shrinking, and it will keep shrinking as long as there's trades going on, whether they're buys or sell. If you come to holders, you'll realize that there's the largest wallet here, the number one wallet. This doesn't belong to the dev or to the community. This is actually a smart contract. And this is a smart contract. It's a staking contract. And so far, there's 76% of the total supply is staked. So over 730,000 tokens are being staked, locked up. What does this mean? It means that the ecosystem is stable and secure. Another thing I want us to bring attention to is there's only 12% remaining in the liquidity pool. And this is where the burning is taking place, right? So whenever there's trade happening, this is the liquidity pool on Uniswap. So whenever trades are taking place, this supply keeps shrinking, right? Naturally, organically through trades. So another thing I want us to highlight, if we go back here and look at it, is lack of liquidity. Liquidity is key. It's very important because without it, there is no trades. Without it, there is no confidence for traders to keep trading. And without it, there's also no volume. Liquidity attracts volume. So due to that, we have a mechanism implemented in place that literally retains liquidity and promotes trade. So another thing is because we are on a proof of stake blockchain, which is Ethereum, you need to have a sustainable and efficient staking platform. How is it sustainable and efficient? Simply by not causing inflation while distributing the staking rewards. And the best way to do that, you need a staking platform that is at least deflationary, if not scarce like the one we have. So as you're issuing staking distributions to the staking participants to secure and stabilize your network, your ecosystem, the distributions you hand out should be sustainable. So you shouldn't be running out of them, or you shouldn't be, by issuing them, causing inflation, causing even more harm to the community by diluting the existing tokens, by causing inflation. But rather, we handing out USDC distributions, and they're based on volume. So the more activity, the more trades are taking place, the more USDC distributions will go out to the stakers. And then finally, we're using the volume efficiently. And if you do so, you'll be, because you're using the volume efficiently, that means you'll keep retaining liquidity with every trade. You keep lowering the supply, causing scarcity, and you'll keep having a sustained amount of USDC distributions that go out to the stakers of the BRL token. This is how we are addressing the 4 challenges we find ourselves in the industry. And to wrap up this session, community, you want to be part of an ecosystem that is addressing challenges in order to come out victorious out of this bubble. Bubbles are essential, and you can't avoid them. Bubbles are needed in order to bring maturity to an industry. And in such a young industry like the cryptocurrency industry is, that is barely at a 4 trillion market cap, there's still 100x, 1000x growth that is supposed to come, and it will come in form of liquidity. And if your ecosystem is not retaining any liquidity, it's not going to make the most out of this bull cycle. And we are getting ready to go through a deep liquidity rush. Like we just saw, 94% are anticipating for rates to be start getting cut in September. Once that takes place, it's going to open floodgates for more liquidity. And like we saw, there's a rush and a huge demand for crypto projects. This is why many of them are going through an IPO, initial public offering. And this is how bubbles will be formed. And out of that bubble, 2 things will happen. The markets will mature, they'll be more stable and liquid. And secondly, most will go bust. And the few or the handful that will make it out of the bubble will be dominating the space. And what you need to pay attention to is look for blockchains that infrastructures are being built, ones with a user base and developers, and ones with fundamentals and not just hype, ones that are part of a solution, not part of the problem, ones that pride themselves in addressing challenges that we are faced with in the industry. So community, this is it for today. I hope the message came across well. And with that said, community, I want to wish everyone a wonderful, wonderful rest of the week. And till we meet again, community, bye-bye, everyone.